maybe people have a somewhat sequential view of their finances. And so they kind of feel like they've leveled up maybe when they've started saving for retirement. And so at this point, I'm starting to adult. And therefore, I'm going to be more responsible, more careful with my finances. I'm also going to go and buy a house. And so that could be part of what's going on too. But at the end of the day, we don't quite know what is happening here. I'm James Choi, professor of finance at the Yale School of Management. Originally, everything was kind of opt-in when it came to retirement savings in the US and in the UK. So if you did nothing, you would not be contributing to a retirement savings account. And you had to opt in, take an active action in order to start saving in the retirement savings plan. Now, what opt-out or automatic enrollment did was say, if you do nothing, you are going to start contributing at a default contribution rate, invested in a default asset allocation, and you can opt out if you want. But if you kind of follow the path of least resistance, you are going to start saving in this retirement account. Now, this was a relatively new concept back in the early 2000s. We did some research, my co-authors and I, showing that it made a big difference in the percent of people who ended up participating in retirement savings. And so that led to some legislation in the US that encouraged employers to use automatic enrollment in their 401k plans, in other words, their retirement savings plans. Now, this was seen in the UK and some other countries as well, and the UK decided they wanted to adopt automatic enrollment as a requirement for employers in that country. And so it was really an example of some research that ended up producing some evidence that produced some policy changes that then produced more evidence that created some momentum to create this mandate over in another country. It has been adopted in the US, and so at this point, a large fraction of US workers are employed by companies or other sorts of employers that use automatic enrollment in their retirement savings plan. So we have a lot of evidence now on what happens, and it's basically you get participation rates in the retirement savings plans that are often above 90%, in contrast to in an opt-in regime where you might get participation rates in kind of the 50, 60, 70% range. And so it's quite a dramatic effect in terms of moving people from zero contributions to something positive. Now, there is a default contribution rate that is chosen, and historically that was a very low contribution rate, something like 3% of your income would be contributed by default. And that was kind of done for some through some accidents of history, some language that was put out in the regulations that anchored companies on 3%. And I think very few people thought that 3% was a sufficiently high retirement savings rate, but that was seen as kind of safe. But you did see a lot of piling up of employees at a 3% contribution rate for a very long time because people are inertial, and so they kind of went with the flow. And so there is a little bit of a cautionary tale there where you want to set that default contribution rate correctly so that it provides a reasonably good outcome for somebody who maybe not isn't paying so much attention to their finances. So that's kind of the first cautionary tale that came out of the experience with automatic enrollment over the past decade and a half, 2 decades. Now, what we weren't able to do in that first wave of automatic enrollment research was to see what happens to the entire household balance sheet. We were able to see what happened in the retirement savings account, where we did see increased accumulation of assets there and increased participation rates. We couldn't see what happens to the household's borrowing, what happens to other assets on the household balance sheet. And what we did in this new paper is to crack open some of those other corners of the household balance sheet where we were able to see in the UK what happened to household borrowing when households were swept up in this automatic enrollment mandate. And what we find actually is that households borrow a little bit more when they have their contributions kind of start automatically through that mandate. And so there is a little bit of crowding out of the extra retirement savings that is accumulated due to automatic enrollment. So it's not that you get 100% of those retirement savings contributions going towards increasing household net worth. Some of it's offset through increased borrowing. There are different flavors of debt, but you can broadly categorize them into secured debt and unsecured debt. Secured debt is debt where there's collateral. So most common forms of secured debt would be your mortgage and your auto loan. So if you stop paying your mortgage, you stop paying your auto loan, at some point the lender is going to come and seize that collateral. They're going to take your house, they're going to take your car. So secured debt carries that risk for the borrower, but on the other hand, the lender gets a lot more security, and so they're typically willing to offer much lower interest rates for a secured loan. Now, on the other end is what's called an unsecured loan, where there is no collateral. There's just basically your good faith that you are going to pay back this loan at some point. And so an example of an unsecured loan would be a credit card. And because it is unsecured, there is less security for the lender. Credit card interest rates are much higher than mortgage interest rates, typically. Now, what happened in the UK is that when you had people swept up in the automatic enrollment mandate, you saw increases in both unsecured and secured borrowing. So on the unsecured end, you saw increases of about 20% of the total increase in the retirement savings contributions. And that increase was primarily concentrated in just unsecured personal loans, installment loans, and a little bit in the credit card margin, but not the majority of that increase. And then quite curiously, we saw an increase in mortgage debt as well. And this really seemed to be driven by people taking out mortgages who otherwise would not have taken out a mortgage in the first place. So it's not that the same set of people are taking out bigger mortgages, it's that new people are starting to take out mortgages because they were automatically enrolled. And this is quite a puzzling finding, because you wouldn't have thought necessarily that just because I started saving extra dollars or extra pounds in my retirement savings account that I'm now more prone to go buy a home. But that seems to be what has been happening. This is another really puzzling finding from the paper, which is that when people are automatically enrolled and they start borrowing a little bit more, they also become more creditworthy. And this shows up not only in an increase in their credit score, but they are actually less likely to have delinquent debt out there. Again, you would have thought that because they're borrowing more, that would naturally lead to more bad debt, more defaults on debt, but the opposite seems to be happening. And it's a bit of a mystery why that is. Some possible explanations are one, that because there was an initial increase in borrowing, that could have mechanically led to an increase in the credit score, which then led to increases in credit limits. Another possibility is that you have now created this commitment to divert some of your cash flow to retirement savings. And so that's going to cause you naturally to maybe cut back on your spending a little bit. But now if you run into trouble, you have this buffer of liquidity, which you didn't have before, which you can stop saving for retirement. And so if you were previously saving zero for retirement, you had no such buffer. Now you have that buffer, just a small buffer, but maybe that's enough to create this small increase in creditworthiness. A third possibility, which is really quite a psychological story that economists tend not to tell, but it could be happening here, is that maybe people have a somewhat sequential view of their finances. And so they kind of feel like they've leveled up maybe when they've started saving for retirement. And so at this point, I'm starting to adult, and therefore I'm going to be more responsible, more careful with my finances. I'm also going to go and buy a house. And so that could be part of what's going on too. But at the end of the day, we don't quite know what is happening here. So we typically do find that automatic enrollment has a bigger effect on increasing savings in low-income individuals, because automatic enrollment kind of has a leveling effect where it pushes everyone towards that default. And that means that high-income people may be dragged down a little bit in their savings, and low-income people are dragged up quite a bit in their savings, just because naturally if you have an opt-in system, it's the high-income individuals who will naturally gravitate towards a higher contribution rate, and the low-income folks might be more prone to be at a zero contribution rate. So that's kind of on the contribution end. And then on the borrowing end, I think you do see a bit more increase in the debt that is associated with lower income individuals. One really interesting development that has happened through Secure 2.0 is that there's been this legislative encouragement for employers to get involved not in retirement savings, but in building up short-term savings. In other words, saving for a rainy day. And so there are some provisions to try to use the 401k retirement savings infrastructure to also fund liquid short-term savings that can be withdrawn at any point in time to fix a flat tire or what have you that happens before retirement. And the thought is that this is going to not only increase short-term financial security, because you can now finance those emergency needs not by borrowing, but by using some of the assets you've accumulated, but maybe also this will discourage people from withdrawing their retirement savings before retirement. And that's something that happens a lot in the US, where people do withdraw a lot of their retirement savings far before retirement age. And so the US is quite unusual in how liquid our retirement savings system is. So that's kind of one part of where I think US retirement policy is going to move, is to kind of move beyond just retirement to financing some of these other needs. Another thing that Secure 2.0 did was it is going to require 401k plans going forward, with some exceptions, to implement automatic enrollment and to implement automatic escalation of contribution rates. And so we're going to see a big expansion in the scope of automatic enrollment in the US. And so that's a new development. I think beyond that, and I think this is not necessarily going to be a legislative change, but just a private sector change that may end up happening, is the advent of customized defaults. Right now, you typically will have the same default contribution rate applied to all individuals at a company, but does it really make sense for a 22-year-old to be saving the same percentage of their salary as a 45-year-old? Very few theories would say that that is the right thing to do. But at the moment, you have a one-size-fits-all default policy, and I think that we may see in the decade to come kind of an introduction of some customized defaults, maybe age-based, maybe based on some other characteristics that the employer observes about their employees. And we already see a flavor of this already in the asset allocation domain. There is an asset allocation default that is legislatively encouraged, where people are defaulted into target date retirement funds, where the investment mix of their retirement portfolio depends on their age. So it starts off more aggressive and then gets more conservative as people age. And there's no principled reason why you wouldn't want to do something similar for contribution rates, where maybe you have higher contribution rates as people enter middle age and have a higher income versus somebody who's just starting out after school, has a relatively low income. Does it really make sense for them to be contributing as much as somebody who is a higher income? We have done a lot of looking under the lamppost because that's where the light is. So we've looked at a lot of effects of automatic enrollment in the retirement savings plan, because that is the margin that we have nudged. But in this new paper, we looked a little bit beyond the old lamppost, looked at what happened to borrowing. We should be looking at what happens to other non-retirement savings. We should be looking at what happens to home buying and other sorts of behaviors. We should be looking at what happens when people change jobs, what happens when you are automatically enrolled over the course of a lifetime. So there are all sorts of kind of broader impacts of automatic enrollment that we haven't studied practically at all, because we don't have the data, or we haven't had the data necessary to do it. And I think we're pushing along those margins, but we still have a way to go.